Most founders think if their business creates impact, investors will want to fund it.
The impact investing world has totally oversimplified itself. There's two types of impact investing: concessional and commercial. Impact-focused founders can fall into the same trap as any other founder, which is falling in love with the solution rather than falling in love with the problem.
I think a lot of founders try and live a bit in lane A and B.
You can either make your business look like other businesses that people want to invest in, or you can go on a much more difficult journey to try and find someone who cares as deeply about the problem you're trying to solve as you do. If you think about investing, right, it's kind of like the Olympics. I like to think of impact investing as being track and field. Concessionality isn't always about the dollar return. It could be patience, right? Flexibility, understanding what trade-offs you're willing to make. Alignment, not just investment.
Dan Madhavan, you've spent more than 25 years working in wealth management and financial markets, and half of that also in impact investing. So what I want to start with is a lot of founders assume that if they have impact in their business model, it automatically means impact investors will want to invest in them. Is that actually how impact capital works?
The easy ones to start with, Jess. So no would be the short answer.
Great.
I think when founders think about impact in their business, it matters a lot what their impact model actually is. And impact models can be quite different depending on how a founder or a team has embedded impact into their business. So to make that a bit simpler, I've got lots of frameworks. Most of them I've made up. So there's no textbook. There probably is a textbook, but it's not one that I've written. The way I think about how you can put impact or embed impact into a business model, in my view, there's 5 ways to do that. So the first way is the impact or the outcome that you're wanting is embedded in the product or service that the business offers. So, sell more product, sell more service, increase impact. The second way is where maybe the product or service that you're selling isn't that impactful, but the group of people that you're employing in the business, so an employment model, social enterprises use this a lot, where they are employing a particular group or a particular cohort of people. Often that might be temporary as well, where they might be offering them training and it's transition to long-term employment. The third model is around, again, not necessarily what is sold or who works there, but around supply chain. So where that business sources its inputs from. And it may be sourcing those inputs from a particular community or a particular region. And that may be providing jobs or livelihoods to people in that community, as an example. The fourth model is around how revenue and profit might get shared. So you've seen models where 50% of profit goes to a particular organization or to a particular cause. And then the fifth model is where a for-purpose organization, typically a non-profit organization, actually owns the business itself. And so in that case, all profits and also the value of that business is accruing to that organization. So depending on which of those 5 models you're running, it really does attract a different type of investor because it has very different financial implications depending on which of those models a founder is using.
And so do people deploying capital into impact pick one of those models typically? How much is this spoken about? Our fund or portfolio is looking for impact that's in category 1 product, or is that front and center of how they're thinking about it?
Sometimes it's probably the right answer. I'm going to totally oversimplify everything, so because it's going to be a lot easier that way. Impact investing can be a quite a nuanced and complex space. So maybe to oversimplify, I would say certain types of models suit different types of capital, or maybe the reverse of that. Some of them don't suit particular types of capital. So, for example, that fifth model, if a non-profit organisation owns the business, well, you can't invest equity in a non-profit organisation. Right? You can lend to a non-profit organisation, but you can't actually be an equity owner in one. The first model, if we think about venture capital appropriate, they tend to want to look at the first type, where the product or service has impact embedded in it. And if that's really scalable business model, then VC might be interested in that. Whereas you can think about the employment type model, is often less interesting for a VC, for example, because if you think about the incentives built into that model, me as a founder, I am wanting to employ as many people as I possibly can and put them through, it could be a training process or provide livelihoods. Most investors are often wanting to invest in businesses that employ as few people as they possibly can, not as many people as they possibly can. So depending on the model, it will be fit for some types of capital and not for others.
And so let's talk about the different types of capital that go through to these different types of organisations. When people think of impact or the capital that goes to it, the ones that will be obvious will be either grant or gifts going through to not-for-profits or grants, but also the investment into innovations and then equity in exchange for that investment. Is that the breadth, or is there more at play?
So there is more at play. I think if you start with a foundational definition of impact investing, it is investing. Right? So the word investment can have very different meanings in different contexts, right? Like governments use the word investment for deploying, which is effectively grant funding, right? Philanthropists will often use the word investment when they're providing a grant.
Because the outcome is the return as opposed to financial return.
Sure.
Yeah.
But when we talk about impact investing, it is you are looking for a financial return, and we can come back to what that might mean, but you are looking to make a profit at some level in a financial sense alongside a social or environmental impact.
Yes.
That automatically puts you into this category of, looking for things that can provide a financial return. So at least my money back, plus, and we'll get to what the plus might mean, plus a return above and beyond that, as well as the social or environmental return that you're looking for. If you think about investing, right, as kind of like the Olympics, if you said, I like the Olympics, well, what does that actually mean? Because the Olympics is not one thing, right? I don't know how many sports there are in the Olympics nowadays, but lots of sports, right? It's lots of different things.
Yeah.
And a lot of those things don't look like each other. You know, rowing looks nothing like the 100-meter sprint.
Yeah. BMX.
So, BMX, okay? So looks nothing like synchronized swimming.
Yeah.
Okay. So they are actually a collection of very, very different things.
Yeah.
So in the investment world, you might have private equity over here and venture capital over there and someone doing small cap listed equities over here. It's a collection of very different things, but under this umbrella term investment. I like to think of impact investing as being track and field. Okay. That's how I kind of make sense of it. Because the impact investing world has totally oversimplified itself, and I'm as guilty as anyone as using this oversimplification of saying there's two types of impact investing. There is concessional, where you're willing to take less of a return than maybe the risk would suggest you should, okay, and commercial impact investing, where you're trying to get the same sort of level of financial return that the risk dictates you should be seeking relative to other investments you could make. And so you're in this world of kind of, commercial returns or what they call finance first versus impact or concessional returns, what they often call impact first. You're prioritizing the impact over the financial. Now, why I call it track and field is like on the track side, which I think about as the commercial, you're in your lane, you know what you're doing, you're trying to get plus, you're trying to get your financial returns plus some impact, okay? And, they're like track, different distances, but it's all pretty much the same thing, right? You're running around maybe over different distances. Whereas on the concessional side, you get lots of weird and wonderful structures, right? Like just like in field, throwing a big metal ball looks nothing like throwing the spear or jumping over, taking a pole and running really fast and then trying to jump over the pole vault. So you get a lot more variation in what people are trying to do and how they're trying to invest and the sorts of structures that they could invest in. Where I think it's really interesting is, and where grants do come into the picture, is over the last, it's been happening in international development for a long, long time, but more recently, the pointier end or the frontier of impact investing is in this space called blended finance, right? Where all of a sudden you're blending different types of capital together. commercial capital, with concessionary capital, and potentially with grants as well.
In a portfolio?
Into a single deal, into a single structure,
wow.
right? Or a single fund. So you can do things that you couldn't do before. If you think about the old capital stack of having debt or equity, now you've got debt, concessional debt, equity, concessional equity, grants that you can put into a single structure that you can blend together. And, hopefully different investors can come into the sleeve that is suiting what they are looking for from both an impact and a financial perspective.
And in what you're talking about there, is it all coming together in pursuit of supporting one organisation, one impact in that, when you say one deal?
Yeah, it could be an organisation. It could be a fund. So you might have a fund that wants to invest in, let's say, a particular, might be lending money in a particular market where commercial investors would say, well, that seems really risky. So it could be in a developing economy, for example, and to a particular cohort of people in that economy. And you really struggle to get commercial investors investing directly into that activity because I say it's too risky for the returns that are available.
Yeah.
Well, if I came along and I said, well, I'm happy to put in a guarantee. I'll guarantee half of the loans, which is another form of concessional capital. Maybe that would make that risk return stack up for those investors. Or maybe the fund is $100 million and I put $50 million in at a very low interest rate. And I say, well, or I'm happy to give up half my returns to the other investors that are in there. There's all sorts of different ways that you can structure it. As someone who's prioritizing the impact, I may be willing to give up some of the financial aspects or take more risk than a commercial investor would, so that I can actually crowd in people to invest that would not otherwise invest if I didn't take that position.
Yeah, it's fascinating. So, it's really interesting, but also extremely complicated.
Yeah.
And so to take it back a couple of steps, if I am a would-be CEO of a fantastic innovation that is going to have the potential of an incredible impact on the world, and I've got a decision point where I can commercialize this thing, and I don't know whether to go turn it into a private sector organization and go get VC backing under an impact umbrella, or keep it as not-for-profit so that then I can access grants and perhaps gifts and other things and perhaps get other types of capital. At that stage of my thought process, how should I be? What do I need to know about these dynamics and blended finance or not to help me make the best decision?
I think the first thing is to acknowledge that if you're going to go down a blended finance route, that's not a well-trodden path yet. Maybe that will change one day. But so I don't want to give people kind of this false sense of, there's this blended finance option and that's really easy and off you go, because I don't think that's right.
Is blended finance available to not-for-profits, or it's still unavailable if there's no equity?
No, you could. I mean, you could blend it with concessionary debt and commercial debt, or grants and commercial debt. I've seen a fund recently that's looking to lend into the creative arts, where one investor is going to take a first loss position in the fund. So they're saying, well, we'll lose all of our money before anyone else loses a dollar. So everybody else coming in has the benefit of that protection, and that de-risks it for them looking at making that investment. So a lot of the models, including the investment models, are still emerging. So it's not a well-trodden path that anyone can just pick the structure off a shelf and say, let's fund our business that way. So that would be the first thing I would say. The second thing I would say is, what is the right capital fit for your business model? And are you realistic about that? And have you tested that with anybody? Okay, so that would be the second thing I would say, because often I've seen founders assume that VC is the right source of capital for them, only to go and meet with a whole bunch of VCs and get no check because their business was never going to be a good fit for venture capital. Understanding what different investor groups, and impact investors are no different to any other group of investors, what they are interested in, what fits their mandate, or what it needs to look like to fit what they are interested in investing in, I think is the second step, and that can come with some harsh reality checks. And then specific to impact founders, which does come into what capital you want to take, is how do you preserve the intention you've got around impact as well? In my view, there's kind of three ways you can preserve that intention. The first of which is ownership. If the ownership changes, that intention can change as well. The other two are governance and then regulation. With preserving an intention, or at least preserving an intention should be something that impact founders are thinking about.
And so they create governance structures or other things to preserve the intention to gain the confidence of the capital coming in, or to make sure that the capital can't change its direction?
Both.
Yeah, interesting.
Yeah. I mean, I think it's both, right? So you can imagine where you may set out with a wonderful intention to build this highly impactful business with a product that's, maybe it has health benefits just for, but over time you've got a bunch of investors now that are riding you pretty hard to improve your margins and improve the reach and like all that impact stuff's great, but let's dial that down. It's costing us money. What do you mean you're employing someone to measure the impact that you've got? We don't need that person. Let's get rid. The whole range of things can come with financial pressure from investors that you may want to be thoughtful about. And likewise, investors that are investing for the impact, they will want some. They'll want to have some comfort that intention would be held as well. The whole reason they're investing in this is. Or maybe not the whole reason, but a big part of the reason they're investing in this is because they care about the impact and they want to see that impact realised. So what they don't want to see is that you kind of change your mind and take it on a different course.
But it's interesting because it makes a lot of sense that these strategic decisions need to be lined up at the beginning of the company's journey, but also realistically, many founders are still figuring out what best looks like at the beginning. So even that decision of what is the real possible impact outcome of this, you might in the early days have a view that is the highest quality impact to the most people, and then through the growth realize we have a decision, highest quality impact or the most people. Which one is it? Lower quality and more people? And you don't necessarily know that question's looming and or where you stand on it till you're 5 years in.
Couldn't agree more. And I think the impact-focused founders can fall into the same trap as any other founder, which is falling in love with the solution rather than falling in love with the problem, because it may be that the solution that they have designed or that they've designed embedded into their business model is not actually having the impact that they thought it would. That's a really, really hard kind of decision to make.
Yeah, it reminds me, my background is not-for-profit. I don't know if you knew that, but I ran a not-for-profit before my startup. And
I've run a non-profit too. It's not an easy gig.
It's tricky, right? But when we created Neighbourlytics, we made it for-profit because we found the structures of a not-for-profit limiting. And so we made for-profit instead. And that also had its own strengths and challenges. But what I really enjoyed about that from an impact perspective is that the vision of the company was how to work ourselves out of a job. So you're always looking at what state does the world need to be in where my business doesn't need to exist anymore because we've solved the problem. And in the end, that's what happened to that business is it created a precedent from a consulting perspective of the thing we were trying to create, and then the world just started doing it. It didn't need a specialist. But that is the opposite of what I then needed to do with my for-profit company, where we were trying to create a world where we were required to exist in perpetuity forever. Yeah. And so, I mean, that tension feels like it would be ever present in an impact space.
I don't know that it's a very natural thing. I know people say it, right? That the whole idea is to put myself out of a job. Yeah. I think very few people, and I don't think that's a personal thing, but I think organizations have their own will to survive, I think. So I in my experience, even when it looks like you may be on track to deliver on your mission, I think a lot of organizations can find other missions. I think the point you make is an interesting one and should be the right one from an impact perspective. You kind of hope that you can create the change that you want to see and job done. I think most of the social and environmental problems are probably not that solvable
if we're worrying about
in that short space of time. But I also think that a lot of organisations can change direction or maybe add things to their mission
Yes.
that weren't there
if we're that
in the
close
early
to
days.
solving some of the climate issues and we're worried that it'll be fixed too soon, then we'll sit down again and we'll reopen the conversation. So let's talk a little bit about how one should think about returns in impact investing. You've already touched on concessional versus commercial, and so that obviously has a flow-on effect to how to think about returns. What is the, do you want to dive into that a little bit more?
Yeah, sure. There is this kind of broad, well, is it concessionary, is it commercial or is it concessionary? And I think
is it a spectrum actually, or is it really one or the other?
It is binary in some sense.
Yeah.
The challenge with returns, like in any investment activity, is you don't know what your returns are going to be until after you've actually received them.
Yeah.
So things that you thought were going to be commercial don't make them guaranteed. Like I think it is a useful distinction between the two, mainly because when you look at an investment as an impact investor, you can make a conscious decision around saying, well, am I willing to trade what returns I might get for the impact or not? And I think that's an important question. There's no right or wrong answer. That's a choice. But I think that's a question worth asking oneself. Now, you might be in a setting where you're working on behalf of a fund or a structure where you have an obligation that means you can't make that decision. That's not your decision. But where it's personal, or it's you might be a private investor or a family office, it's your money. You can do what you want. So then, you're in kind of that land. And then if you get into the more complex space around, I'm willing to trade off financial returns for the impact, then you get into the detail of, how impactful do I think this might be?
And I think perhaps a lot of founders might think of it as they still are seeking a great commercial outcome, but they might just need to be slightly more patient with it so that they don't sacrifice the impact along the way. We're seeking the growth that we want to seek, but we're not going to sell our product to that market. We're only going to sell it to that one because that's where the impact sits, and therefore it might take 5 years to get there rather than 3.
Yeah, and that's an interesting point, right? The concessionality isn't always about the dollar return, right? You can be
maybe the patience of the capital.
It could be patience, right? And so, I'm willing to give them longer, or I'm willing to have my money in there for longer, or I'm willing to take less liquidity, or I'm like, there's all sorts of things that you could be concessional on. And so, I think a lot of it has to do with flexibility, and that flexibility can come in many, many forms. That flexibility is about understanding what trade-offs you're willing to make. And I get that there's a whole bunch of people that only want to play in the space where there is no trade-off. I'm not sure I believe there's no trade-off. But I don't think we should shy away from having a conversation about where trade-offs might be worthwhile.
And so is it the case then, given blended finance and the different structures of return, that an impact investor will be happy to achieve a lower return because of the impact that comes with the outcome? Because sometimes, that kind of question is brought up a lot, right? No, you have to be just as commercially viable as an investment. Just because you have impact, don't expect concessions there. But it sounds like perhaps that's not always the case.
I don't think that. I don't buy that. But that's because I don't think there is one set of rules that everybody follows. Like I see people invest in things every day, and not even non-impact things. Where I'm like, that sounds like the worst idea I've ever heard, right? But someone thought it was a great idea.
Yeah.
So you are operating in a market, and that's on the impact side. It's often as much a market of ideas and aspirations as it is a financial market for returns. And so if you meet someone who has a deep interest in a particular issue, or cares deeply about solving a particular problem, I think they might have a flexibility around the financial returns that they may receive that goes way beyond just looking at it as a financial exercise. I don't know. Does that answer you? Does that answer your question?
Unfortunately, I think your answer is that it's really complicated and it's always different.
Yeah, everything's complicated. Like it's like I wish there was one simple answer. Like sure, just make it fit this box and go over here. The biggest problem I see for impact founders is you can either make your business look like other businesses that people want to invest in,
Yeah.
right? You can make it look like something that the last VC fund backed or the last family office backed or the last, that got raised capital last week. So you can go and make the thing you're building fit that, or you can go on a much more difficult journey to try and find someone who cares as deeply about the problem you're trying to solve as you do. And that's not easy. Like it's also maybe in some cases it's easier, but often if you're trying to solve some kind of quite niche problem or you have some really novel solution, it can be really hard to find someone that cares as much about that particular problem as you do.
Yeah. And I think a lot of founders try and live a bit in lane A and B.
Yeah.
Might be dressing it up as the first option, as you've said, but then also have the backup one in their pocket, and they're really hoping for that if they can find it.
Yep.
Yeah.
Yep.
And so
And I totally get why they do that.
Yeah.
Right? Like it's hard you're trying to solve some niche thing. You're trying to pitch people on, hey, I've got a solution to this particular problem.
Yeah.
I don't know how many people, like depending on what the problem is, there might not be that many people that are that interested in that problem.
Yeah. And then saying to the rest of the market, oh, but don't worry, this will still make sense commercially either way.
Yeah. And also, like if you care that much about the problem, most of these, like even if we just park climate and the environmental, like social, a lot of the social problems that people are working on are really complex.
Yeah.
Like really complex.
Yeah.
And how do you get that complexity across to an investor in a 15-page slide deck, right?
Yes.
Like I don't like if you say took a hyper specific and said, well, I want to work on youth homelessness in Melbourne, right? Well, that's not like one thing. My business is going to solve all of that, and it's one specific thing. You're into all sorts of other social issues and issues around who gets funded, what services are available.
Yeah.
It's not just about, well, I've got this simple solution, which is we're going to provide this house on this street and job done. Like it's just not going to be as simple as that.
How much is it the case, and I don't mean to sound like a cynic because I'm definitely not, that capital will flow to impact investing or otherwise because it is good to put your capital in places where there aren't a whole lot of people solving that problem. You know, it's good investment practice to be ahead of the trend and solve the things people are going to be worried about for the next 10 years, not the last 10. And often impact innovations sit at that frontier of what society cares about, what we might be worried about for the next decade. Like how much of the capital going to impact is going there because it's the trend or what is becoming socially palatable as opposed to the actual impact itself. Like climate, for example. Yep. Cynics in the room will say certain large funds invest in climate because their customers expect them to, not because they're really seeking, or because it's now the social expectation that big corporates are putting money into that. It's not necessarily because they're striving for the outcome itself.
Yeah.
It's being ahead of the trend, seeing the impact topics as the next frontier of things to solve.
Look, I don't know is the answer. Like I mean, it's hard for organisations to care, right?
Yeah.
Like I don't think they've got feelings. So, like it's the people in those organisations might care, but then how much of the how much decision making power do they have as an individual, and how much they get to decide based on what they individually care about? Like I think that's difficult. Is it in the last? Well, I've been in the space for 12 years or something like that. Over the last 12 years. Do I think we're in a better spot because more institutional money seems to be focused or willing to invest in a way that is thoughtful about the impact on climate and what it's investing in and, where dollars end up and what activities it support. Do I think that's good? Yeah, like it's better than not. Do I think it's happening as authentically, deeply, quickly, whatever word you want to use? Like, no.
Does it matter? That's the question.
Well, I think it does.
Maybe not.
No, I think it does.
It does matter.
I think it does matter because I think what ends up happening, and I'm wrong about a lot of stuff. I could be wrong about this, right? What happens is we start with this really powerful idea, right? Like we go and take the cordial and we put it in and then we kind of got to dilute it by, we're not allowed to do this and it's got to look like this. And, we end up in a spot where, we're investing dollars that are meant to be green in oil companies who are trying to do a better job, right?
Yeah.
Like, and I'm like, I just like we're ending up with, you can put so much water in the glass that it ends up just being effectively water.
Yeah.
Right? Like we've lost the potency of what it was meant to be. There's a point at which it becomes so watered down that let's not call it cordial anymore.
Yes. I would feel frustration over that effect. I didn't have quite such a good analogy, but when I was in the property sector, where there was a huge swing into sustainable built environment technologies, and I'd find myself sitting in conferences where the developers were talking about the collections of innovations and how on aggregate they were all incredibly green. But at the end of the day, they were still building large box format shopping centres that required cars to get to them in a totally decentralised city way. So the city wasn't getting better, but at an individual project level, it appeared like everything was getting better. And I sort of had this conundrum of, they've checked the box, but have we actually created the impact that was leading this in the first place? I don't know that we have. Yeah.
And I think that's kind of it's very similar to the way I feel. Like if you think about it at a system level, are we actually, how much is actually changing?
Yes. So who has those questions? Do the funds have those questions? Like talk them through, or is it just conversations like this where they surface and we think, oh God, there's a lot of work to do?
I don't know. I'm not in those. I mean, that's not my world anymore. I probably don't have the patience for those conversations. I'm more interested in the questions that are happening, the conversations that are happening on the frontier of this, and they're not things that are mainstream yet. Like blended finance is a good example. I think it holds a huge amount of potential to fund things that couldn't be funded any other way, and that holds a lot of promise. Yeah.
And so in the new frontier of blended finance, what are the types of organisations getting involved with that? If that's the new and emerging space, who is coming forward and participating in terms of deploying capital?
Blended finance has a kind of heritage in international development.
Yeah,
right?
okay.
So that's actually where a lot of the models have emerged. There's an organisation called Convergence who I think are wonderful, based out of Canada, and you can go on their website and they've got lots of information about the four archetypes of blended finance. So where you're blending commercial capital with grants, or you're blending commercial capital with concessional capital, or you've got a technical assistance facility alongside an investment that pays for all of the stuff, like it could be training and things like that an investor doesn't want to pay for as part of their investment. So there's different models. It has a heritage in international development, and so therefore you see a lot of the development banks and foundations that have kind of interest in economic development. They have been the first to use these types of models. They're now becoming more common structures and models for philanthropic foundations and even some of the family offices to look at in the US, here in Australia, in the UK, etc. They're starting to become a lot more interest in how those models could be used.
And in Australia, what organisation types is the majority of capital coming from? Is it private investors, family offices, or is it superannuation or corporates?
It depends on the sorts of investment. So I'd put the impact investing world into three very broad categories. One would be impact businesses, like when we talked about the different models that are there. Second would be real assets. Okay, so you can invest in housing, you can invest in whether that be social housing, affordable housing, specialist disability accommodation. So there's a lot of real assets, renewables. So a lot of institutional capital is interested in real assets.
Yeah.
And then the third really kind of esoteric space is like payment by outcomes models, where we've seen things like, bonds that are linked to the conservation of the black rhino. And we've had social impact bonds in Australia and elsewhere. So, but there's a whole bunch of kind of where you're linking the impact to the financial return in some way. Right. So across those models, I think you have more institutional participation in real assets, to a limited extent in funding businesses that can have an impact. But even that tends to be specifically in PE and VC.
Mm-hmm. So Dan, if I was an investor in an impact business, or perhaps considering investing in an impact business, what would be the red flags I should be looking out for when I'm considering that investment? Meeting with the founder, looking at their structures.
There's all of the standard stuff that you should be looking for if as an investor in any business. The difference is going to be their impact model, right? So I would be looking for what is their theory of change? Like how robust is their thinking around the impact model that they have? What right do they have to solve that problem?
Mm-hmm.
Right. So what lived experience might they have of the complexity of that problem that they're working on? I would want to understand how the incentives are aligned in terms of the impact that they want to have with the business model itself. Mm-hmm. Is impact embedded in the business in a way that as the business grows, the impact grows, or is there some other way that they have aligned their own personal incentives, but also the business's incentives to deliver impact? And how do how the red flags might be? How could that intention be shifted or
watered down
or whatever over time?
And how much would you be looking at who else is on the cap table or in the governance structure of the organisation, on the board and those things?
Yeah, I think it depends on what stage you're investing as well, right? Like if you're investing early stage, like maybe less so, but the later stage, I think those are real governance questions, particularly as much around impact as they are around the financials.
And if I was then on the board of that new and growing impact business, what questions should I be asking the founding team about how they're thinking about capital and what capital might be available to them? Should we be looking for someone with a blended finance structure, or is that in the too hard basket?
I think the number one question would be, who are the right type of investors for us?
Yeah, okay.
Are we bringing in the right type of capital that can support our impact model? Because maybe you've got a highly scalable business that has a wonderful impact model and an impact VC is the perfect investor for you, right? But maybe you need really patient capital to work on a really complex problem and you think there's a business there, but it's not necessarily going to be the most profitable or high growth business, and you need a really patient investor who cares deeply about the issue. So
and that's not an impact VC.
That's not a VC. My ideal answer would be a philanthropic foundation who is aligned in terms of the impact that they want to have. Most foundations will have, here are the themes we're interested in, or here are the social problems that we're interested in. They will be granting to those to organisations that are trying to solve those problems, and the question becomes, why wouldn't they also be investing? So it's a bit of an overused and kind of argument, but most foundations give away 5% of the value of their endowment each year. Okay, so if you're giving 5% away to a particular social issue that you care about, what's the other 95% doing? Right? Ideally, some of that money would be set aside to try to find not just things to grant to, but things that they might be able to invest in.
Yeah. Now, I'm going to hit you with a tricky last question,
okay,
but it's because we've talked about how complex and diverse the impact investing space is, like track and field. What would be the one piece of advice you would give someone looking to deploy capital into impact if they want to start that journey? What would be one piece of advice to help them get started in navigating the complexity?
I'd start with, well, why do you want to do that?
Should they have a theory of change? What they're trying to create with this?
I mean, yes, and I'd start with a personal kind of theory of why you're doing it in the first place. Because if the answer is because I want to make as much money as possible, like there's probably easier ways to do it. If it is because I care about this particular, there's something in the world that I would like to see changed, how much do you care? Depending on the answer to that, right? I think your answer then helps you answer how flexible you might want to be about how you make investments.
Great. Well, thank you, Dan Madhavan, expert on wealth management, financial markets, and of course, impact investing. It's quite a mouthful, but thank you for joining me today.
No worries. It's been a pleasure. Thanks for having me.